Hi everyone, welcome to MAGNiTT's fourth webinar, this time focusing on demystifying legal for fundraising startups. We have Donya Fredj with us, Legal Director at Clara Partners. Donya will be sharing some very high-level insights with us that will help all early-stage fundraising startups. The function of the session is basically to go through at a very high level all of the legal things that you need to know and to give you guys a chance for a Q&A. Donya, can you tell us a little bit about yourself?
Thank you, Noor. So my name is Donya and I am a legal director at Clara Partners, as Noor mentioned. I've been based in Dubai for 4 years and a half. Prior to joining Clara, I worked as a corporate lawyer at an international law firm and recently moved over to Clara to help startups with their fundraising rounds.
Okay, so I'm going to be asking you the questions from the perspective of the early stage founder. So the questions might be a bit, challenging. So my first question, and I think a question a lot of people would like the answer to, is before fundraising, what kind of legalities do I need to have in place before I can think about raising my round?
Okay, sure. So I would say there are at least 3 or 4 key issues that founders need to think about. Often founders are not aware of these issues, and when they come to do a funding round, they find that the round can sometimes be delayed because they haven't necessarily resolved these issues. So the earlier they can kind of resolve them, the better.
And what do you think are the 3 most important things that founders need to have in place as they start to think about this process?
Sure. So number 1, I would say, is establishing the relationship between founders. So in the case of a startup that has more than one founder, you really need to be having discussions with your co-founders at a very early stage.
This is the Founders Agreement, right?
Yeah. So initially you need to be establishing, you need to just have a conversation at first and ultimately reflect the terms that you agree into a written agreement. So for example, what are the roles and responsibilities of each founder?
What happens if someone leaves, for
example?
Exactly,
that's a key issue, right? How much capital is each founder contributing? What percentage of the company are they going to own?
Yeah.
Putting all of that into writing, although I know founders can be a little bit apprehensive about spending money on legal costs, that's going to save a startup a lot of hassle in the future.
Okay. And we hear a lot about BVI or offshore, onshore. Can you tell us a little bit about the role incorporation plays?
Yeah, sure. So in terms of incorporation, just generally, your corporate structure, you need to have an operating company. That is the company that obviously operates business.
So that's a startup.
Yeah. So let's say for example, you're in Jordan, you're in Lebanon, you're based in Egypt, whatever. You have an operating company in that country. Of course, you need to be thinking about where is the most appropriate place for you to incorporate your operating company. There's a lot of factors that go into that. It's very specific to the business and your long-term goals. Yeah. Often lawyers can advise on that. And once you've established that, you then need to consider, okay, in contemplation of a funding round, where should I incorporate my holding company? Because investors, let's say you are based in Lebanon or Egypt or Jordan, investors are not going to be as comfortable investing in those entities simply because those jurisdictions are not as startup friendly. And also they're just not as familiar with the legislation there. Okay. Whereas incorporating in somewhere like BVI, Cayman Islands, ADGM is a great option as well, will give the investors a lot more comfort.
Okay. And I know you speak a lot about IP and why it's important. Why is that?
Okay, so intellectual property is one of the most valuable assets of a company. Okay, there are 2 key issues related to IP that founders should be aware of. Number 1, you need to be thinking about how can I protect my IP?
Yes.
What steps can I take? Whether it's getting a trademark for a distinctive name or symbol, or a patent for a unique invention. The way to do that is to really approach an IP specialist lawyer. They can advise on that because there's no real single formula. The other thing related to IP is IP assignment. Now, what does that mean? That basically means the transfer of any intellectual property to the holding company itself.
So it's not owned by me, the founder, or...
Exactly. Yeah. So anybody that has access to that IP, generally the founders, employees, consultants, advisors, they should be entering into what's known as an IP assignment agreement, or at least their employment or advisor agreement should contain IP provisions that deal with the transfer of IP, so that the company is able to fully own that IP and license it out.
And do you think investors are a little bit squeamish when that IP is not assigned to a particular holding company and is assigned to a person rather?
Yeah, no, absolutely. Because the risk is, like you said, if an employee leaves tomorrow or a founder leaves, they may have claims to establish ownership over that IP, and then suddenly the value of your business has declined significantly. Right. And equally, if you're looking at the long-term kind of vision, if you're wanting somebody to acquire your business, again, the purchaser is going to be looking to make sure that the company holds the IP so that it can continue to operate the business.
And as a founder, is that something that you should be comfortable with? So I know that sometimes when investors make investments, there's a clause that says that they could potentially fire the CEO, who is in many cases the founder. So if the IP isn't in the founder's name, rather in the holding company, doesn't that put the founder in a very difficult position if things turn sour?
No, because, at the end of the day, when you go into a business as a founder, you go in with a vision to make this business successful. You have to be willing to ensure that the value lies in the business. If you can't expect to start a business and leave and then take that IP
right.
with
Especially
you.
if you've gotten external investment, right? So we've covered very briefly the three most important things, but is there anything else before I talk about fundraising options that startup founders should know?
Yeah, just on a very high level basis, it's very important for startups to maintain a record of their documents and records, so their legal documents, financial statements. The reason being is that when you do come to do a funding round, investors will typically be requesting those documents for the purpose of what's known as their due diligence process, DD. So you can significantly reduce the timing involved if you already have your documents stored properly. For example, it can be very simple. It doesn't have to be like an expensive database, Dropbox, Google Drive, whatever it is. If you already have those documents there, it saves you a lot of time.
Okay, so now that we are kind of on more solid ground in terms of what I need before fundraising, there's a lot of confusion around debt versus equity as fundraising options. Yeah. So can you tell us a bit more about that?
Yeah, sure. So, just first of all, let's go through what the options are and what they mean. So, like you said, for debt, we have, principally convertible loan note. Okay. The way that's structured is basically as financing from the investor to the company. Okay. So it's like a loan. The loan note will specify an interest rate and it will specify a maturity date. Maturity date being the date upon which company is then obliged to pay the investment back to the investor.
Right. So that can be paid back in equity, or paid back in cash.
So typically the way it works is the convertible loan note will say that if what's known as a qualified financing occurs before the maturity date, qualified financing being a full priced equity round that occurs above a certain amount. If that occurs, then at that point, the convertible loan or the investment plus any accrued interest will automatically convert into equity in the company. If a qualified financing doesn't take place, then typically at the maturity date, there is a repayment obligation. But sometimes there is an option at the maturity date for investors also to convert their equity.
So if the startup meets that certain maturity date and it hasn't raised an equity round and it simply doesn't have the money to repay that, are the founders at risk of going to prison? I mean, what does that mean?
No, obviously there is a risk there for the founder in the sense of, typically as a startup, you don't have that much capital. So at that point, what do you do? However, like in practice, typically, right, investors, they invest in a startup because they want returns, they want a result. So it's unlikely that the investors will not be willing to extend that maturity date. Usually the startup can have a discussion with investors and look to agree for an extension, especially if it's looking likely that a financing round is going to take place soon.
But what is the worst case scenario?
The worst case scenario is that there's a repayment obligation.
And what happens if they're unable to repay that?
I mean, it's essentially a debt, right? I mean, you know, if they need to try to find the cash from somewhere. I mean, the worst case scenario is that the company doesn't have any cash left and it ends up going, you know, having to be bankrupt, and then the proceeds will come out from that and be paid to the investors.
Okay, understood. And a convertible is also like a kiss and a SIG, right?
I mean, there's been alternatives to the convertible note that have developed. You're right. The KISS stands for Keep It Simple Security, and the SAFE, which is a simple agreement for future equity.
Okay.
The SAFE is not actually debt, so it works in a similar way to a convertible note in that it structures the financing. It's different from a convertible loan note in the sense that it doesn't structure the financing as a loan. So there's no interest rate, there's no maturity date.
Okay.
But it's a simple, basically, exchange of the investment for equity. So the investor will give you money, and in return, the investor can apply that investment later on towards the purchase of shares in the next funding round.
And on a very high level, an equity round is what?
So an equity round is essentially, I'm an investor. I give the startup money, and in exchange,
you give my startup money.
Yeah, yours. And in exchange, I get shares, equity in the company itself.
Okay.
Usually, if you're an investor, you'll be offered what's known as preferred shares.
Right.
They basically rank ahead of the ordinary shares, and they get preferential rights over, for example, dividends, over liquidation.
Yeah. Okay. But before we get too technical, as a founder, as an early stage founder, perhaps raising my first round of funding, what would I rather have, debt or equity?
So the key disadvantage with equity is that it is very expensive, and it's time consuming. Well, I mean, it depends obviously what lawyers you're using to engage. You know, if you're using an international law firm, they're going to be charging by the hour, so costs can run very high.
Yeah.
If you're going to a legal service provider that's more catered towards startups, I mean, for example, Clara, you know, we fix our fees.
Yeah.
But you know, you're looking at the range of at least around $25,000, let's say, for a full round. And obviously, you know, costs vary depending on specific circumstances, but typically you would need to have a term sheet, shareholders.
Wait, but before I cut you off, how expensive is it to have a debt? Like a
so in comparison, whether it's a convertible loan note or a SAFE or even a KISS, which is kind of a hybrid between the two, it's significantly cheaper because it's just, you know, it's just a few pages long. So, you know, I don't know, $3,000 maybe, something along the lines of that, depending obviously on how many safes you want to put in place and with how many investors.
Beyond the initial cost, right, which is obviously very clear, what is the major difference between me, for me as a founder, between the two?
So first of all, with a convertible loan, I mean, we've already discussed it, is that risk of the repayment obligation.
Which doesn't exist with equity.
It also doesn't exist with the SAFE either. The great thing about the SAFE is that you never have to repay the investor.
Right.
Also, with a convertible loan note, you're obviously carrying debt on the company, which can adversely affect the company in the long run. Like we talked about, you know, potential for liquidation and so forth. In terms of the SAFE, the only real main disadvantage maybe is that investors may not feel as comfortable with it as, you know, the convertible loan note.
Right.
Having said that, we see the SAFE being used a lot nowadays, but just something to bear in mind. In terms of equity, as I said, the main disadvantage is cost and timing. The great thing about the convertible loan note and also the SAFE is that it does defer valuation and it defers ownership dilution, whereas with equity,
it happens instantly.
Yes. That's not necessarily a bad thing. The thing with equity is you've got such lengthy documents that they establish clear rights, clear obligations. You know exactly how much the investors are getting.
Right.
Whereas with a convertible loan note, for example, you don't know what that's going to be like.
Yeah. So let's come back to the thorny issue always of money, right?
Yeah.
So if we're talking about 25K or 2 to 4K, obviously startups are, if they're raising their first round, might very well be bootstrapped, right? So who typically pays for legal? Is it the investor or the startup?
So look, as a startup, you'll have your lawyers. The investor will also have their lawyers. If you're looking to put a SAFE in place, you know, the startup will typically be responsible for paying those fees. The investors may have lawyers reviewing that and pay for their own fees. So it's kind of basically each party pays their own fees. even with an equity round, that generally is the case where each party pays their own legal fees. However, it's very typical to see a requirement within the documents that the startups also pay for the lead investors' fees. Usually, we would suggest that you incorporate kind of a cap on the fees. Just for example,
it seems a little unfair.
I've seen requirements for startups having to pay investors' fees up to an amount of, say, $50,000 even.
That's so much money.
Yeah, and put that together with the fees that the startup has to pay as well. This is why I'm saying that you need to think carefully about doing an equity round. When you're asking yourself, am I ready to do one? You need to think about how much money am I raising? If you're raising, say, $200,000, then frankly, doing an equity round doesn't make sense.
Right.
If you're going to pay a substantial amount of that towards legal.
Right. Okay. And so bearing in mind these costs and the fact that a lot of startups actually can't incur this cost immediately, right? When does it make sense to engage legal counsel?
So 100% you need to engage them on a fundraising. Okay,
that's where in the fundraising process.
So I would, generally advise that founders engage them from the term sheet stage.
Right.
Sometimes we've had the cases where startups come to us after having signed the term sheet. It's perfectly possible to engage lawyers after that stage, but the issue there
because then you've got the security, right, that the money will come in.
Yeah, but then the issue is that you look at the term sheet and you suddenly find that investors have dropped in a number of investor-friendly provisions that are not necessarily for the benefit of the founders. And so although the term sheet technically is not legally binding, with the exception of a few provisions, it just makes it more difficult to steer away from what you've already agreed when you come to put those provisions into the long-form agreements. So if you can get lawyers involved from the beginning, they can often advise on the implications of any investor provisions and also suggest alternative, more founder-friendly provisions.
Right. So I know you said that the term sheet is not legally binding, but I'd just like to take us back to the founders agreement, right?
Yeah.
Is there a way for founders to put together a founders agreement that doesn't involve lawyers?
That's a good question. I mean, I'm sure there are, templates available online, and I've seen people even just put something together very basic themselves, like it almost looks like a term sheet, just a simple 1 or 2 pages. Always say something in writing is better than nothing.
Right, but there's no need to reinvent the wheel, right?
Yeah. But obviously, the benefit of having lawyers is it's going to be a much more comprehensive agreement.
Of course.
Because even if you put a term sheet in place at the very beginning, that's just 1 or 2 pages that deals with your founder relationship, you may find that by the time you come to do your funding round, you'll need to prepare a more comprehensive agreement that deals with certain issues that investors are looking for.
Well, it seems like it's quite difficult to be a startup engaging legal counsel, but I know you guys are working on something.
Yeah, so
that will make all of this much easier and more accessible.
I know startups are sometimes fearful of engaging lawyers. And look, I've worked in an international law firm. I know the costs; they are high. But the great thing now is there are a lot of alternative legal providers coming up. And at Clara, what we do is we cater towards startups.
Right.
Aside from the legal work we do, where we actually assist with the venture capital financing rounds,
on whose side? On the startup side?
Always on the startup side. We're always on the side of the startup. Aside from that, we are building a platform, which you guys can access actually, if anyone is interested.
Yeah, I'll be sending out an email to everybody who is on this webinar, and I'll have the link as well.
Yeah, so with the platform, what it's aiming to do is to really empower founders, and by automating the kind of the legal startup experience. So essentially the platform will be a way for startups to kind of manage their portfolio. They'll be able to see all of their stakeholders, their shareholders, directors, investors. They'll be able to use the platform almost like a data room for storing all of their legal documents and financial documents. But they'll also be able to have access to a health check report, which basically identifies any gaps or issues in your kind of maybe your corporate structure or your documents that you need to resolve in order to get to a funding round. And in addition to that, there are template agreements that you can use for funding. So it's a template safe IP assignment agreement. And finally, through Clara Academy, there's also access to videos, articles, and materials just for general education.
Right. So as we're running out of time, we're going to move towards the Q&A. And so I'll go through the questions. I'll ask you the questions, and then you can answer them, and I will resolve them as we go. Okay.
Sure.
So our first question is, What's the preferred structure of fundraising in seed stage in the UAE, equity-based or convertible debt or safe round?
Okay, so if you're at a seed stage,
we've got a lot. Sorry to cut you off. We've got a lot of questions.
We'll have to
we can be very brief. Yeah.
So as I said, it really goes back to the point of how much you're looking to raise. Seed stage, if it's a fairly small amount, then you may be better off going down the convertible debt or safe route. If it's a fairly substantial amount, then an equity round could work. I mean, all of these are common alternatives. It really comes down to how much you're looking to raise.
All right. Are VCs and angels comfortable with convertible debt / safe? What's their preference?
Yes, absolutely, perfectly comfortable with it. Convertible loan note obviously has been around much longer. The safe, was introduced as an alternative to simplify the seed financing stage. For a company, safes do have advantages in the sense there's no debt and no repayment obligation for the company. So safes is slightly more founder friendly, I would say, than the convertible loan note.
Okay. Where would you recommend incorporating a startup that mainly targets GCC markets and has international founders?
Okay, so a great option, I mean, there are a few, but a great option potentially is the Abu Dhabi Global Market, ADGM. Obviously, when we're advising startups on their holding company, we usually do ask questions about the business and the long-term goals because that can factor into it. But from a general perspective, the great thing about ADGM is that it's well regarded. It's based on the legal system is based on the English legal system, has very sophisticated legislative system, transparency, very startup friendly, and we see it as more and more being used as a holding company.
Is it important to have an IP for a software company?
Yes, I mean, if you're a software company, IP, it's probably going to be one of your most valuable assets. So absolutely, in terms of what IP you have and whether you need to protect it. Again, unfortunately, as I said, there isn't really one response. You'll need to kind of approach an IP lawyer, and they'll need to advise you about the steps that you need to protect it.
Nada, unfortunately, we can't explain the convertible loan note again because we're quickly running out of time, but I'm sure we can be sending through resources, and we'll be also sending through the recording of this. Thank you. Is it the same with an accelerator or an incubator? Because I've been following something like 500 startups and Y Combinator, but never heard about such complications or legislations that the cost around 25K USD. So are these steps apply for all kinds of investors? Can I answer?
Okay, so 500 startups, they introduced the KISS, Y Combinator introduced the safe. When I'm talking about the fees for 25,000 or
the difference between
we're talking about an full priced equity round, and the reason is they are very long documents. You're looking at a term sheet that could be around 8 to 10 pages long. The shareholders agreement and the subscription agreement could be anything between 30 to 50 pages long each. You also have to update your articles of association to reflect the provisions of the shareholders agreement. You may have a disclosure letter. I mean, the list kind of goes on. So unfortunately, because of time, I can't go into more explanation, but they are very heavily negotiated documents, hence the expense.
So who would help us to engage in rounds? I'm not sure I understand that question. But if you're looking for investors, you can do that on MAGNiTT.
Yeah, I mean, as lawyers, our role is really limited to the legal. So usually you would come to us once you have investors in place.
Okay. For a negative earnings company like e-commerce, what is the best way of valuation? Multiplier effect, EBITDA, discounted cash flow methods, etc.
Valuation, to be honest, is a huge issue that requires a lot of explanation. Just very briefly, there are two ways of evaluating a company. There's pre-money valuation, post-money valuation. Pre-money valuation being the valuation of the business before an investment round, post-money valuation being the valuation after the round. The most common would be pre-money valuation. Unfortunately, I actually don't think there is time to go into it, but what I'll do is, as Noor said, there will be resources that will explain valuation in more detail.
Yes. So how about the key differences between tech and non-tech sectors when it comes to standard legal documents, i.e. we are non-tech traditional startup in oil and gas?
Okay, so legal documents, I mean, if you're looking to do, like, for example, for equity round, the documents are very standard. You know, even a SAFE or, you know, or a convertible note, all of them are very standard documents. So there's not going to be a huge difference, you know, just because of the difference in industry.
Right. BVI or Delaware?
Good question, actually, because I see a lot of startups going for Delaware. The one thing to be aware of is, although that may seem like quite a quick and easy option, Delaware is really only appropriate if you're looking to potentially conduct business in the US. The reason is that it adds a huge administrative and cost burden to you. You need to hire a tax specialist and you'll need to file tax returns every year. So if it's a comparison between the two, I would steer away from Delaware.
Right. We've got loads of questions and we're fast running out of time, so I don't know if we're going to be able to answer all of them, but we thank you for your patience. Right. What is the difference between a convertible loan and a SAFE?
Okay, so this is what I already explained, but just very quickly, convertible loan is basically, think of it as a loan where there's an obligation to pay back the investment if it doesn't convert into equity. Whereas with a SAFE, you will never have an obligation as a company to give the investment money back to the investor. It's just simply an exchange of investment for shares in the company.
Right. We are a startup based in Saudi Arabia. Where is the best place to register our HQ? Depends, right?
Again, depends. Unfortunately, you need we need a lot more information about the business, what you're looking to do. It's very tailored advice.
Oh, we have quite an interesting question here. Hang on. What stage should you register a company if you're working from home?
That is a good question. A lot of startups delay incorporation of a company. However, I would say once you have a business idea and you're ready to kind of launch and go for it, you should register the company as soon as possible. The reason being, it has a lot of benefits for you as a founder. First of all, as shareholders of the company, you won't be liable for any debts or obligations of the company. You'll also, as I said, be able to transfer your intellectual property to the company, which will make the company have a lot more value. And also, when you come to do a funding round, at the end of the day, investors want to see a company. They need to be able to invest in it to get shares.
Right. Hang on. What did I just see? Oh, there's questions in the chat and that we can't follow. So if you've got questions, if you could just put them in here.
This one, key documents required.
Yeah. Please, can Donya list the key documents required for raising? She mentioned term sheet, shareholders agreement, and what else?
Sure. So term sheet, very quickly, just is a summary really of the key commercial terms, which facilitates the drafting of the shareholders agreement and the subscription agreement. The subscription agreement deals with the investment amount that the investors will pay and the amount of shares that they will receive in return for that investment. Typically will include the pre-money cap table and the post-money cap table. Mm-hmm. The shareholders agreement is an agreement between all shareholders of the company, and it governs the affairs of the company itself. So, for example, board composition, voting rights, transfer of shares. In addition to those two documents, you will also need to amend and restate your articles of association to reflect the key provisions of your shareholders agreement.
So because we've run out of time, we'll just take 3 or 4 more questions, but we're also, I think Donya would be happy to come on board for part 2 if we have enough people that are interested in doing that. We'll have to ask her very nicely. So we'll just take 3 or 4 more questions, right? As long as they're quick. So, right, is a term sheet binding? To what extent can investors have the option to back from it?
Yeah, so term sheet generally is not binding, and usually the term sheet will actually explicitly say that it's not binding, apart from specific clauses like mainly costs and confidentiality. As I said, it is possible to depart from the term sheet, but it's a lot more difficult to have that conversation with your investors because they will always use the argument, but you signed the term sheet, why are you backing away? Now, if you have good lawyers, they should be able to negotiate for you and you should be able to come to a compromise in a good position. But it goes back to my point that it's always recommended to have lawyers with you at the term sheet stage, and then you can just avoid that conversation from the beginning.
Right. If the startup is incorporated in Delaware, does the money transfer have to be done to a US bank account or can it go to the UAE?
That's a good question, actually. And I'll be honest, I actually am not 100% sure on that. We actually only do incorporations in the ADGM through our sister company Founder. However, I'm happy to look into that. If you want to send your question through, I can get back to you on that.
Okay. Sorry, just trying. Can we change the sweat equity treatment every year? Add it 1 year and not add it the other?
I'm not sure I understand that question.
No, me either. It's okay. We can get questions later. Okay. And then the final question, and actually there's 2 final questions that I'm gonna ask Donya. What's your recommendation on dividends for preferred shares during an early round?
Yeah, so with dividends, typically preferred shares would have a preference over dividends. That's pretty standard. You can try to negotiate for otherwise and just have, you know, dividends distributed between both preferred shares and common shares. But it is typical to expect investors to have a preference over those dividends, and then the dividends to be distributed among ordinary shareholders afterwards.
Can mainland companies in the UAE with 49% shareholding raise funding, or do they need to be registered as 100% holding free zone company?
So again, you know, whether you're based in a free zone or you're an onshore, you need to have a holding company in another jurisdiction that's more acceptable for investment. You know, for example, the ADGM would be a great one. So if you, for example, if you've got an operating company in the ADGM, it would be fine to have your investors invest in that, although it's not technically a holding company. We simply recommend that you have a holding company in place in addition to your operating company, because that's just best practice.
And then actually our final question, in what situation do I have to ask to sign an NDA?
Okay, well, I mean, you know, different situations, but you know, NDA is obviously just to protect, you know, confidential information. So if you're at the very early stages and you are looking, for example, to get co-founders on board, or you're discussing your IP with anybody, it's always a good idea to have an NDA in place to protect that confidential information.
Understood.
I mean, ideally you should be limiting disclosure of your information anyway, only disclosing it to really key stakeholders. But yeah, NDA is good practice.
Okay. And that's all we have time for, but we are actually going to be sharing the webinar on MAGNiTT, and I'll be sending everybody a link. So we were very oversubscribed for this one. We had way more people than we had spaces. So I'm glad you were all able to make it. And if you have any questions, I think we can be connecting you to Donya afterwards. Thank you so much.
Thank you.
Bye.
Bye.